Good morning. It's Tuesday, the 5th of August, and this is Govindraj Ethiraj broadcasting and streaming weekdays from Mumbai and in Mumbai, India's financial capital. Our top stories and themes: could the Sensex hit 100,000 by next year? Could lower US interest rates send more fund flows to markets like India? The rupee falls despite the dollar index also going down. Oil prices slide again. British Petroleum, and now BP, makes a big find off Brazil. How Indian seafood exporters are trying to cope with new US tariff structures.
This is a core report with Govindraj Ethiraj.
The markets and the rupee. Investment banker and brokerage Morgan Stanley has put out a bullish report on Indian markets, saying the Sensex can hit a 100,000 mark by June 2026, which is a bull case with a 30% probability, according to a report in Money Control. Morgan Stanley's also included other not-so-bullish capabilities, which sees the Sensex at a lower mark. Now, the reasons this could happen, according to Morgan Stanley, is India's strong population growth, a functioning democracy, macro stability, influenced policy, better infrastructure, rising entrepreneurial class, and improving social outcomes, all of which are in progress or work in progress. So it's not clear whether this is the exact trigger, but maybe Morgan Stanley sees this as a longer-term trigger and therefore is arguing for a stronger case for re-rating of Indian markets. The report by Morgan Stanley, as part of its India equity strategy playbook, said that one should get ready for new highs in the months ahead, as India could gain share in global output in coming decades thanks to those strong foundational factors. So the reason I'm mentioning this upfront is that there are other, at least two in this case, reasons that Indian markets could see some shifts, and both are somewhat shorter term, and I'll come to that in a moment. So on Monday, the Sensex and Nifty were up thanks to a prospect of an interest rate cut and earnings flows. While there is some hope of an interest rate cut at the conclusion of the Monetary Policy Committee meetings tomorrow, a realistic assessment is that, of course, it's unlikely this time, because even if we want to respond to a tariff shock, the Reserve Bank or the central bank may wait a little to see how or when the transmission actually happens. The Sensex was up 418 points to close at 81,018, and the NSE Nifty 50 was up 157 points to close at 24,722. So the markets did begin on a firmer note this week. The rupee did not. It lost ground unusually despite both the dollar index and crude oil prices falling. It closed 12 paise lower at 87 rupees 66 against the dollar, according to Bloomberg. And earlier in the day on Monday, it had opened higher. A Business Standard poll says that a majority of its respondents saw the rupee at about 88 to a dollar, with some support at 86 rupees 50 paise per dollar by September 2025, which of course is just next month. And then there are, of course, fresh salvos being fired by President Donald Trump all the time. In the latest one on Monday night India time, he said India was not only buying massive amounts of Russian oil, they are then, he says, for much of the oil purchased, selling it in the open market for big profits. He also said India did not care much for the people in Ukraine being killed by the Russian war machine, because of which he would substantially raise the tariff paid by India to the USA, which of course means the tariffs which would mostly be paid by US consumers, though it could also be split between exporters here and importers there. So given all of this uncertainty, where are the markets headed now? I reached out to Vaibhav Sanghavi, CEO of Ask Hedge Solutions, which runs alternate investment funds. And I began by asking him to tell us a little about his fund itself, and more importantly, what was in his mind right now and what he thought were going to be the triggers in the markets in quarters ahead.
We manage a absolute return fund. Of course, our core competence is long-short strategies, and we manage strategies across the risk spectrum. But our flagship fund is an absolute return fund generating returns irrespective of market conditions. Now, we can do that purely because we have an ability to go long and short on the markets, and that is what we've been doing for the last 20 years. So it adds as a great value add to the portfolio, looking at a debt plus kind of returns.
Got it. So if I were to now come to the markets, I mean, we've had obviously a lot of factors playing into prices. They include, of course, earnings. They include the state of the economy, that's the Indian economy. And of course, there's this whole issue of where tariffs will finally settle. Because at this point, of course, we are staring at a more firm figure of 25%. But is all of this going to influence where markets go, or is there something else that you're looking at as you look in the next couple of quarters?
No, of course, Govind. I think what we've seen, first of all, in the last 6 months have been nothing short of an extremely volatile period, which included lot many geopolitical events and, of course, the tariffs as well. Now, tariffs at this point in time has not ended in that sense, and you are seeing every day some new developments kind of happening on that ground. What we are expecting from here onwards is that India's trade deal, potential trade deal with the US may happen, but not at right at the second in that perspective. It will take some time to negotiate and eventually turn into a trade deal which may be beneficial for both the countries. While that kind of happens, my take is that incremental news on tariffs is having a diminishing effect on the markets. So I do think that beyond the point, it'll get discounted, and to a great extent, it's already been discounted. But what we're keenly watching here is the movement of the interest rates from a US perspective. There's a lot of exchange between the president and the Fed. We will wait and see how data kind of pans out. And if that kind of happens, then we may see very interesting times, especially for emerging markets.
And that could obviously be a longer term trend. So, why is that? I mean, and how does this contrast to, let's say, previous periods of low interest rates or greater emerging market flows?
Perfect. So if you see in 2021, right, when rates actually started moving up from a US perspective, there's a direct correlation between US rates kind of moving up and the subsequent flows coming into the emerging markets as a basket. And if you remember, in the year of 2022, once the rates kind of started to spike up, in the calendar year of 2022, we witnessed one of the highest redemptions from India perspective, which is a capital outflow, which is close to about, say, $20 billion for that year. Given that, if that kind of movement generally would have happened 10 years ago, then the market would have taken a very severe beating. But fortunately, I think the domestic investors kind of compensated and we were good. But that continued over the next 3 years. Eventually, if you see from a 3 year perspective, the net inflow from an FPI perspective has been nothing in that sense, right? So when now we look at a scenario when US may start decreasing probably the rates, then there is a full possibility that the emerging markets as a basket will attract some good amount of inflows. Of course, India being 20% weight in that emerging market kind of basket is likely to get some good inflows if that kind of happens. But and if that happens, just mind you that we are currently at a decadal low from an FPI ownership in India. So the moment the flow comes, and it will be probably crowding in, during that period of time, which may expand the valuations during that stretch.
And I'll come to valuations in a second, but are you saying that this is perhaps the only major trigger that we are now or could now look forward to in the markets? I mean, whether or not it happens, is there any other cue that we could be looking out for or could save us, so to speak, from the markets going sideways in the next few months?
No, of course, purely because I'm not saying that that's the only one. I can say that that can be a big delta. Okay. Now, in a normal context of things, what do I also believe is that if you look at the GDP construct, which is your investments plus your consumption and plus your net exports, we had investments pretty much in place for the last 10 years. This is the first time post the last election is when we are seeing a very coordinated action from the central government, state government, and the central bank towards boosting the second leg of your GDP growth, which is your consumption, right? Of course, net exports is something which is up in air. We don't know what's happening to the global economy, so that's something we may not take a call on. But when we do think that your investments were in place and consumption getting back because of the concerted effort by all the government agencies, is when we do think that the GDP growth might probably surprise over the next 12 to 24 months on the upside. Now, if that kind of happens, then the earning revival is something which is pretty natural and will happen, in my view, in the second half of this financial year, which will probably take the markets up.
Right. And when you say if you feel that there's more investment likely to come, I'm assuming one of the contributors to that was the tax relief that middle class taxpayers got. I don't know how that's panning out now because it's already a few months. That would only help part of the market, right? Or do you see that helping the entire market?
Of course, it will help the consumption leg of the GDP kind of construct. Now, it is not only about the tax rebate. Of course, that is very, very important and can be a good contributor. But also, if you see, when the rates gets decreased from the RBI, then your EMI kind of also gets down, right? Which adds to your disposable income. Lastly, from a personal loan perspective, unsecured loan perspective, the risk weights also have been kind of reduced so that the banks can go and lend to those kind of pieces or tools who kind of give incremental consumption. So all in all, when you look at the combined effort, my sense is basically consumption is set to revive.
Yeah, right. And interest rates have been brought down. And I guess in 6 months to 1 year, we'll see more transmission of those lower interest rates. So let me come back to valuations. So all of this is linked to valuations. And what's your view on them right now?
Of course, valuations, if you see from a relative perspective, we always have prisms of valuation which we look at. Somebody looks at market cap to GDP, somebody looks at P, somebody looks at price to book. There are various different connotations. Now, over a longer period of time, we have seen that markets follow the earnings trajectory. In between, it can go anywhere. But as we keep on looking at growth of earnings likely to happen, market will surely follow them. Now, from a PE perspective, when we look at large cap, in my view, still looks reasonable. Mid cap and small cap, there is some pocket of overvaluation. But I'm very, very comfortable with those kind of valuations purely because if they are able to show the growth, then you will always see that the valuations may remain elevated over a longer period of time. And lastly, if the FPIs also kind of come about, then I think the valuations may remain elevated on an absolute basis or relative basis.
And when you talk about areas within mid cap or small cap that you're comfortable, are you talking about companies or sectors? And if sectors, could you name one or two?
Sure. So I think from a relative valuations perspective, if you see the new age economy stocks or probably newer business models, I think their valuations to some extent are discounted by FY29, FY30, and so on and so forth. Now, I'm not saying that they cannot remain elevated. In fact, what we are seeing that they are kind of grabbing market shares because of the technology prowess. So they will remain elevated and your headline, that's why I'm saying the headline number may look expensive, right? But as I said, I would be fairly comfortable. But from other sector perspective, what we also do like from the next 12 to 24 months perspective, of course, we are getting very, very constructive on the consumption basket, which for all the reasons which I've mentioned earlier. One that is under-owned as well is where we do think that the delta into the price performance will be much, much higher. Secondly, financial services is something which we continue to like. Rural focus sectors, because of the strong monsoons, we are still very positive on that as well. So all of these sectors are something which we continue to prefer.
Right. And you also short, you said, right? So what would you be shorting at a time like this?
See, I think all the global exposed sectors to a larger extent, which is exposed to the uncertainty on a day-to-day basis from ongoing tweets, are something which we would think that we would probably go underweight on or probably avoid, those kind of sectors.
Got it. Vaibhav, it's been a pleasure talking to you. Thank you so much.
Thank you very much, Govind. It's a pleasure always.
And here's a message from a sponsor. Want smarter investing at your fingertips? With InvestingPro, get real-time market data, custom alerts, and global financial insights all in one place. Join 46 million users already making sharper decisions. Download InvestingPro today. More details in the link below. Oil prices slide. Oil prices fell in early Asian trade on Monday after OPEC Plus agreed to another large production hike in September. Brent crude futures were down to about $69.20 according to CNBC. OPEC Plus agreed on Sunday to raise oil production by 547,000 barrels per day for September, and this is one among many accelerated output hikes to regain market share. Elsewhere, fresh oil fields are still being discovered. BP has said it's made its largest oil and gas discovery in 25 years offshore Brazil. BP is also now in the midst of a strategic shift away from renewable energy to refocus on fossil fuels. Yes, you heard that right. It's away from renewable to refocus on fossil fuels and focusing on its oil and gas portfolio to regain investor confidence. A Reuters report quoted BP saying it planned to create a major new output hub at the Boomerang discovery in Brazil, which is probably the company's biggest since Shah Deniz in 1999, a gas and condensate field in the Azeri part of the Caspian Sea. India's seafood exporters. India's seafood export industry is worth roughly 60,000 crore rupees and is a good case study of what smaller enterprises are going through right now, particularly in the export space, as they try and negotiate this phase of uncertainty and what lies on this side as well as the other side. Remember, more than half of Indian seafood exports go to the United States. The current 25% tariff now on Indian exports will make life very tough for Indian exporters of seafood divided between the west and east coasts, with shrimp mostly farmed on the east coast. The industry's woes are also symptomatic of what exporters in general are grappling with today, regardless of what product they're exporting and what could sometimes work in their favor. Remember, many of them have decades-long relationships with their importer counterparts in countries like the US, and that obviously helps in times like this. Ecuador, India's closest competitor in marine exports and geographically, of course, very close to the United States, has to pay only a 10% tariff to the US. Indonesia is at 19 and Vietnam is at 20. I reached out to Pawan Kumar ji, president of the Seafood Exporters Association, and I began by asking him what the last 3 months were like since tariffs started rising.
The seafood exports out of India is close to about $7.5 billion, of which US notably is the biggest market, where we export close to about $3 billion. And we export to about 70 countries across the world, including the US. When you talk about the product categorization, shrimp is the topmost, which occupies almost 40% of the total exports. And then you have the sea cod material, that is a fish and other cephalopods, and the sea cod shrimp. That occupies, when you talk about terms of volume, it is 60%. When you talk about the shrimp, it is the cultured shrimp, which predominantly goes from the east coast of India. And the fish and other categories go out of the west coast and south coast of India. Fish, you have like pomfrets and cuttlefish, squids, mackerels, a lot of other varieties of fishes which are exported to various countries in the world. And US is the biggest market for shrimp.
Right. And if we were to build on shrimp specifically, how have things been in the last 3 months vis-a-vis competitive pressure from other markets, given that you're already facing a 10% duty into the US?
See, in shrimp, when you are specifically exporting to US, we have three kind of duties and tariffs which we pay. One is the anti-dumping duty, which has been there for almost 20 years now. And second one is the countervailing duty, which came in last year. And the third one is the new tariff, which has been in effect from the 2nd of April and which was revised again last week. These are the three kinds of duties and tariffs which we pay. The anti-dumping duty is roughly around 4.5%. It is 1.35, but it's likely to go up to 4.5%. And the countervailing duty is about 5.7%. And now the tariff is about 25%.
Okay, so what would the total impact be? You're saying is it going to be 25 plus 5.8 plus 4.5, or is it a subset of 25?
Yes, the total tariff and duties together will end up paying about 35% today. Of course, we have one more rider which comes with the tariffs, that is the penalty. We are not sure how the penalty is going to come out in the future as and when it is levied.
Right. And would other countries also be paying the same anti-dumping and countervailing duties?
Not exactly. If you look at our first competitor, the nearest competitor is Ecuador, which pays anti-dumping duty of about only 4%, and they don't have countervailing duties, and their tariffs are about 15%. So Ecuador, which is our biggest competitor, will pay about 19% today, and we are somewhere close to 33%, 34% now.
But it's interesting that you're saying both countervailing duty as well as anti-dumping duty have been in force even before these new April 2nd tariffs came into force.
Yes, you're correct.
Okay, so my sense is most people would not know about this. Okay, if I were to now come to how things would have been in the last few months, I mean, can you tell us a little about how negotiations have been progressing? Because I spoke to you a few months ago and you were saying at that time things were still, people were working it out. But how are things now? What I mean is between, let's say, importers in the US and exporters in India.
See, initially when a 26% tariff is announced on the 2nd of April, yes, there was some sort of a disturbance. And then eventually it was brought down to a baseline tariff of about 10%. Somehow, we could convince the buyers, and the 10% tariff got absorbed between the buyer and the seller. And we made sure it doesn't impact the farmer. But having said that, and then business went on smooth. If you see from mid-April, May, June were quite okay. As we came close to the July 9th deadline, that is where the problem started, because a lot of things were clear that there's going to be an additional tariff on India, because the trade deal didn't happen as per the deadline, which was on the 9th of July. And post 9th of July also, the US government was announcing tariffs on other countries except India. They, I think, waited for about 3 weeks. All those 3 weeks were a little bit uncertain, but still we continued with our shipments, not in a big way, but they were going. But when the tariff was announced towards the end of July, that 25% is something which came in as a shocker for us.
Okay. And I don't know if you can share figures of, let's say, a kilo of a certain product from the point it leaves India and it reaches a store in the US. What is the sort of the price movement and how much of that could be shared? And at this point, who will have to absorb more of that price as opposed to maybe not absorbing it earlier, as you were saying?
See, I'll give you a small example. Let us say a unit price of product which is moving out of India is somewhere around $3.60 to $3.70 a pound without the tariffs. But this $3.60, $3.70 is including the anti-dumping and the countervailing duties which are already in place. So when the new tariff came up, 10% was mounted on them in April, and the buyer could absorb it to a larger extent. And then slowly, when we came to this 25%, which was announced last month, now we are not clear on how this 25% has to be absorbed, because it is too early. It is only 3 or 4 days since this has come in. And the presidential order was only given on Friday, if I'm right. Now, the dialogue between the buyer and seller should start anytime now to see how this can be absorbed and how this can be readjusted in the pricing, or where it has to be readjusted is something, which we are still discussing with various stakeholders. That is the importer and the farmer here, both.
And I'll come back to that in a second. But you mentioned Ecuador, which obviously has a geographical advantage because it's in the same continent. Now, do people who buy, the importers, or for that matter, the consumers, I mean, do they care about where it's coming from, or is it transferable? As in, I could be buying shrimp from Andhra Pradesh or shrimp from Ecuador. I may not know, and therefore it's commoditized to that extent, or is there a band preference?
See, I'll answer that question in a different way. When you look at the US market, there are 3 different segments in that market. One is the retail segment, like the Walmarts or the Krogers or the Safeway, all the big people, the Targets and all these people. 2 is food services, that is a big restaurant chains who buy a lot of shrimp from various parts of the world. And third one, what we call as a street sales. Street sales is, the importers, they buy, sell a few hundred cases here, there, and, they distribute locally. When you look at the food service and retail outlets, they place long-term orders. Some people, they buy for 3 months, some people, they buy for 6 months, and some people, they ask for a yearly contract also. So I think that more or less answers your questions. The first impact will be at the street sales level, because they're all spot buyers. They buy for today. That is the area which gets affected first, because they cannot pass on those duties or whatever the increase in prices to their end consumer that easily. When it comes to the retail and food services, probably they have a better cushion. They were able to absorb the 10% quite fast. Now, this 25% is something we have to see how we absorb between the retail and the food services.
And who's the biggest in these 3 between the, let's say, the Walmart, Kroger versus restaurants versus street sales?
I think Walmart is the biggest, if my memory is right. Then comes your food services, like your Cisco's, and then you have your Costco's who buy a lot of volume from India. But by far, I feel Walmart is the biggest.
So you're saying that big stores would be the biggest customers of Indian shrimp at this point?
Yes. So for them to shift their products from India to some other destination, people like Walmart, it's not easy for them to shift their purchases, divert them into other countries. The reason is very simple. When you're selling to Walmart and any of the retail outlets or the food service people, there are a lot of approvals which have to be done in the process, right from the farm level till the factory level. Your hatcheries, the feed mills, your factories, all these have to be approved. So getting the same kind of approval process in the other countries See, it's not impossible, but it might take a little bit time for them to shift immediately. So the immediate impact will be on the, the street sales, and then it will be followed by others.
Right. And I guess supply chains act as a moat of sorts, because obviously if you've built a supply chain over the years, including all these factors that you pointed out, it's not easy to replicate or replace. And both the importer and the exporter would work together to try and see how much they can continue. Okay. You talked about products that are already out, as in produce that's already seaborne heading towards the US. So is it clear at this point what the duty impact there will be?
Yes, to a larger extent, once that president's order has been released, the product which is already on water may not be that badly affected. Maybe a few hundred containers might be affected, but largely the product which is there in water may not be affected, because they've given probably a breather for products which are reaching US shores before end of September or early October will not get into tariff, provided they're on waters by the 7th of August.
Right. Last question, Pawan. So what are you looking out for now? One is, of course, the government part, which we don't know. Many exporters are hoping that there will be some reduction, rationalization of these duties. But what else are you looking out for?
See, we did have series of meetings with the Ministry of Commerce. One thing we have told them is, we understand and we support the government that India first. Come what may, we have to protect our country's interest. And as Seafood Exporters Association, we are with the government. We all understand and we all respect the fact that India's interests have to be protected in the international market. There's no two ways about it. Having said that, yes, there will be certain situations which were created out of the tariffs and other things. We need to find a solution slowly so that, the trade at large is not impacted. So we gave a few suggestions to the government to have a look at those suggestions and say if you can do a little bit of hand holding in such a way that, we tide over the crisis. We do understand it's not going to be a long-term issue. It will be a short-term, and I'm sure the government is also actively working towards finding a solution for the deadlock in the trade negotiations. I think the delegation is coming towards the end of the month. We are hoping that, we find a solution to the existing situation.
Right. Pawan, thank you so much for joining me.
Yeah, pleasure. Thanks. Thank you so much.
There are some small rays of hope. The India-UK free trade agreement, which is now signed but to be implemented, can help the industry double or triple its export to the UK, but the base is much smaller, just $100 million right now. Exporters, including, of course, seafood, are hoping that there are deals or more opening up with countries like South Korea and Australia, and, of course, the European Union bloc. The US is still by far the largest market, but that could, of course, change over time as Indian exporters are able to penetrate other markets or there are other shifts. That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.